Hi, it's Jeffrey Cohen, U.S. Advanced Computing Infrastructures, Inc. I'm the president, investment advisor representative. We make money selling advisory services, financial planning, but also we run a pretty complex computational model, quantitative analysis. And today I'm going to share with you that we're risk off. I've been tweeting this all day, and so I figure I might as well tell you. And thank you for watching the YouTube video, by the way. If you like the video, hit subscribe, drop a comment. I love it. I'll respond to your comment. We can have a whole chit chat. You can also call me. Numbers on the website, chicagoquantum.com. So, risk off. I actually left this up here. I want you to see it. When we lower expectations in the stock market for stocks to go up and risk-free returns go up so that you could just take your money and throw it in a bank account and make more money. What does it mean? What happens? Well, it's risk off. We take less risk. So let's talk about what that means. What do you mean, Jeff, we take less risk, and why? So, we're looking at the stock market. Really, over the past 5 days, it's been pretty weak. It went up a little and it came down. It's really not a strong market right now. Kind of a weak market. And I'm not talking just today, but go back like a month and the market screamed higher. Look at that. In a month, the market is up. NASDAQ's up almost 14%. S&P 500's up 6%. These numbers are very high. And so we don't think fundamentally that the markets have much more to go up in 2023. We think that we're reaching the point of saturation. And so we don't see it. Now, the good news is we see dividends. Great. Oh my God. The dividends in this market are like 1.57%. That's terrific. So count on that. But for capital gains, I don't see it, right? A lot of people don't see it. It's not to say I'm right. It's the expected value of capital gains, of stock price appreciation over the next, right now, 11 months, 10 and 3/4. So if you don't see it, you lower your expectations, plus risk-free rates of return are up. Let's take a look at the 1 month Treasury bill. 1 month. By the way, you can give your government the money for 4 weeks. You go to treasurydirect.gov, treasurydirect.gov. You can log in and you can buy bonds. It's crazy. Look at that. A 10-year note is giving you 4 1/8. That's really high. You can buy savings bonds, double E bonds. You can also find, you can bid at auction if you have a lot of money, right? Let's just say you have a lot of money and you want to do a 17-week bill. 17-week bill. Holy crap. All tenders at lower rates. So 4.7%. So you can get 4.7% on your money. Why wouldn't you take that, right? So you'd have to really believe that stocks are going to deliver like 9%, 18%, like big numbers. Okay? You can get 4.7% right now from the Treasury today. Now, actually, you buy them today, but they issue them on the 14th, Valentine's Day. So what do you give your sweetie? Hey, honey, I got you 4.7% yield with no risk. That's a nice gift. I got to tell you, if my wife said to me, Jeff, for Valentine's Day, forget the dinner, forget the roses, get me 4.7%. on a 119-day Treasury bill, my heart's going to expand. My love for her will just grow. 4.7. You know, our model's using 4.55. That's 15 basis points higher. Like, that's a big deal. So I'm just telling you why I believe we're risk off. And even I'm surprised, just to tell you. So when it says 1 month treasury at 4.57, there's another way to look at this too, which is you can go to Yahoo Finance. They do a 3-month thing. Hang on, let's look. Don't get distracted. Don't get distracted. So 13-week treasuries, 4.59. This is 4.6. It's close, but you can get 4.7 now. I love it. Love 4.7. Okay? So what does that mean? It means risk-free rate of return is higher. It's higher. Love it. And so at the same time the risk-free rate of return is higher, right? Stocks are coming lower. Kind of makes sense. So where are we at? Jeffrey, where are we at? So if we look at 3 years in the market has screamed higher and has been falling. And so who knows? But I don't see it screaming up higher much. I see it continuing to show weakness. I could be wrong. Could be wrong. It doesn't matter, actually. What matters is if I were to talk to 100 people, I bet you 90 of them would say, oh yeah, we're going to go up maybe 5%, maybe 10% at most, but you're probably going to see the stock market go up 3 to 5%. So let's call it 7%, 7.5%, right? So now I want you to feel with me. I want you to feel the love. We're going to take a look at our model. This is where I share with you the big money. The big money prizes, Jeff. Where are we at? First thing I want to do is I want to show you what happens when you think the market's going to go up 6%. Okay? So I said 3, 5, 10, who knows, right? So we ran the model assuming a 6% capital appreciation over the next year, plus a 1.41% dividend yield. And that's across the 3 exchanges, the QQQ, the IWM, and the SPY, which is effectively S&P 500, Russell 2000, NASDAQ 100. Now, they've delivered -10, -3, -17 exclusive of dividends. So figure -9, -16, -3. So it's not like they've even been going up. They haven't been. So the expected market return to risk, which offsets your risk-free rate of return, is 3%. So your value, your gain for risk above expected return, according to 1950s math, is 3%. So what do you do? So let's take a look first off at some other data. So we have some thresholds that we use. Just, 4.55% risk-free rate of return. We use a market cap threshold of only $10 million. So we want to include all the stocks. 10,000 shares per day traded minimum. That's not a lot of shares. It just means that at least it traded every day. What else is interesting? These are all global companies that are listed in the U.S., and we include them. We include them because we want to have all of that kind of nasty access in there. We want rough stuff. We want RIG, Transocean. We want Rogers Communications out of Canada. We want all this weird stuff. Wix out of Israel. Nice websites, by the way. So what we found is max and min volume was 35,000 for the day, and then 96 million shares. for the day. So there's a lot of volume disparity. Validated tickers, there's 2,831. That's a lot of tickers, right? Expected returns range from 4.61 to 13.25. Here's what we found. The Chicago Quantum net score power is 3. That's a very low number. And so think of it this way. The value of returns is 3 times the cost or tax of variance. 3 times. So we're only at 3 times return over risk. That's not a lot. 7% expected return if you held the whole stock market. All 2,831 stocks, including those foreign stocks. Look at that. Zynga is in there. You can own some Zynga. I think I got a shirt from them. Actually, I do. I think I got a shirt from them. My dad gave it to me. The all-stock variance is 3.5 times 10 to the negative 4. And so, what do we got, Jeffrey? What do we got here? Well, the first thing, or the second thing to look at is when the Chicago Quantum net score is negative, it's good. When it's 0 or minus 2 times 10 to the 19th, which is 0, rounding errors in Python, you're at the whole market. So anything better than 0 means you're better than the market for an individual stock. Anything greater than 0 is worse. So the first thing we're going to look at is the best stock, even without looking at the list, because sometimes the names can bother you. The stocks aren't very good, meaning there's not much in the way of alpha in the market. So let's take a look. Any of these that are negative would be good, meaning they're better than holding all the stocks together. And so the first one is to buy short-term treasuries. I'm just saying. What are you people thinking? It's risk off. Risk off means buy treasury bond ETF for 1 to 3 years. Holy crap. I can't make this up, okay? I want to. I do. I want to be wrong. But the best stock picked in our model is bonds. The second is PNM Resources, which is New Mexico's regulated electric utility. Okay. Then you have the Spider. Then you have Activision, Icon Enterprises. By the way, huge dividend, right? But now we're back to the Russell. Buy the Russell. Equity Commonwealth. Okay, fine. Buy physical gold. But that edge is so tiny, but there's still a positive edge. And you got Johnson & Johnson. Love it. By the way, be careful with the talcum powder. That can cause disease. And then you got the QQQ. And then you got Pepsi. And now you're down to just rounding errors. Ametek, McDonald's, Mondelez, Coca-Cola. So when I look at the model and I look at the high flyers, they're risk off. McDonald's, Coca-Cola and Pepsi, Johnson & Johnson, Icon Enterprises. You know Carl Icahn? He's like 99 years old. I love that guy. Energy genius. That's risk. First off, that's risk off. Okay? What else is risk? Jeffrey, what else is risk off? What does it mean? What do you mean? I don't know. What do I mean? Guys, what do I mean? Hey, risk off. What do I mean? Let me tell you. And first off, I will tell you that interestingly enough, our bespoke simulated annealer did not give the best answer today, whereas it has in the past. The best answer, they're all about the same. Best answer came from a genetic algorithm that was exhaustive. It ran through every parameter of every stock against every other stock. And it ran 252 generations. It automatically shuts down when it runs 22 generations without improving. And then it went through, we did a reverse simulated annealer. So I want you to think about a quantum annealing system like D-Wave systems. Well, we coded a proxy for it, right? So it's a simulated annealer where it goes from cold to hot, but this one goes from hot to cold. No. The other one goes from hot to cold. This one goes from cold to hot. Oh my God. So we have a hot to cold, and then we have a cold to hot, right? So we reverse it. What's cool about reversing it is you get a slightly different edge. Now, the reverse simulated annealer gave a better answer. For all you physicists out there, think simulated annealer. Think D-Wave systems. And you can run D-Wave in reverse as well. So now, the fact is I can run this on a Dell server that I own, and it doesn't cost me anything, but I love D-Wave systems. Big fan. I own some warrants for D-Wave. Just don't use it right now. So we take a look, and actually, interestingly enough, the genetic algorithm exhaustive seeded approach gave a slightly better answer. Maybe I should do these longer. Maybe I should let it run all night. All night I'm going to let it run. I don't think so. This thing ran hours already. It's killing me. So much electricity in the house. I don't even need to put the heat on. I got the servers running, right? So what does it mean, Jeffrey? What does this mean? Risk off, what did it mean? It means that after running a genetic algorithm, two different ways, a bespoke simulated annealer, a reverse simulated annealer, and a genetic algorithm seeded with all the best stock portfolios, the best answer has 33 stocks in it. Okay? 33. It has gold. It has Apple. It has Activision. It has AVGO or Broadcom. It has CME, the Chicago Mercantile Exchange. It, of course, has PNM Resources, which is that public utility in New Mexico. It's got McDonald's. It's got J&J. No surprise there. Icon. But it's also got Google. It also owns some bonds. It's also got the long bond, TLT. It's got Texas Instruments. So you got a lot of stocks that you got to hold. This actually feels like what I would call a real mutual fund, which we run a managed account, separately managed account for clients, and we use the model to run it. And so that fund right now, if we stayed true to the model this morning, would have had 33 stocks in it. And 2 of them are bonds. So it's hard to think that you're going to, get a lot of return, get a lot of gains. So that's why I say it's risk off. You're buying bonds in the stocks, and you're buying 33 stocks. And I bet you I could run this for another 4 hours and maybe get it down to what? 31 stocks, 30 stocks? See, 31 stocks isn't as good. You see that? It's just a slight edge. You can still do 31 stocks. It's fine. You get rid of something. I don't even know what you're going to get rid of. I'd probably have to take a look at it. But it still has Google in it. Still has J&J. Still has Shy and TLT. So, it's okay. So risk off means lots of stocks, low risk, right? We have a lot of platycurtic stocks, which is interesting. We have a lot of leptokurtic stocks. This is not a normally distributed stock market. We have a lot of stocks with a positive skew. We have a lot of stocks with a negative skew. So this is the third movement of stock prices. This is the fourth movement of stock prices. These are non-normal returns. And look at this number. Look at the kurtosis value. 173. 3 is normal. 3 is normal. The hell stock has a kurtosis of 173? Wait a minute, where is that? Oh, it has a high variance. The highest low variance is MGI with an 82.83 and a variance that is just at the variance of the overall market, a little bit lower. And so, yeah, in the skews, based on a 0 rating, 10.8 to negative 12. So we have massively skewed stocks. We have massively leptokurtic or platykurtic stocks. And if you want to, beat the tape, you got to hold 33 stocks. That's risk off. What else do you want to know? I mean, some people, right, they want to know, talk to me maybe about negative beta. That seems interesting. Do I have beta in here? I'm sure I got something about beta. Here we go. So, Jeffrey, can I hedge my investments by buying stocks that are negative beta? Well, the answer is probably not. I'm not going to say that it won't ever work, but over the long term, we notice that these are not sustainable betas when they're common stocks. Of course, if you buy an ETF that is synthetically engineered to have a negative beta, that's pretty good. So if we take a look at the negative beta stocks, because some of you may want to do that, U-Haul has a negative beta of almost 1.0. So I actually tweeted on this last night. U-Haul is an almost perfect negative beta. So let me think about this in macroeconomic terms. People rent a U-Haul when they're down on their luck and they're moving. And they can't really afford a home moving service. So they buy a truck. I've known people to use U-Hauls. I've helped people pack a U-Haul. It's true, right? Always down on luck, okay? You throw the crap in there. Maybe you get some boxes at the grocery store. Maybe you can afford to go to Home Depot and buy the boxes. But in many cases, they just threw the shit in the back of the U-Haul. And they drove to their new apartment. Damn it. And so we got those little fungus gnats from the plants. We brought the plants inside, and I overwater them, and it's bad news. So U-Haul is for when times are rough, can't pay your rent, move into a cheaper place. Maybe the landlord is coming for you, right? So negative beta means when the stock market's going up, it's going down. Okay. So, but I noticed Berkshire Hathaway with an 8% negative beta. I noticed some other stocks that are just really terrible performers, but that's like a 0.04 for Cytokinetics. Houston Energy is effectively 0. So really, it's Molecule Group. I have no idea what they do. Veru, I don't know what they do. And U-Haul, we all know what they do. And Berkshire Hathaway. So when the stock market's been going up, Berkshire Hathaway's been going down. I'm not sure why that would be. Because I thought Berkshire Hathaway invested in stocks. And so when the stock market goes up, you would think Berkshire Hathaway goes up. But maybe it rose too much. Maybe there's issues. I don't know. Firm specific. It doesn't feel good to me that U-Haul is negative beta. I don't know. I'm struggling with this, right? And the VIX, of course the VIX is very, very much negative beta. That makes sense. You're short, the stock markets are negative beta. And this most of you may not know, but the US dollar index, bullish, is negative beta of 14%. So when the dollar goes up 1%, stocks go down. Or when stocks go up 1%, it usually means that the dollar has gone down. It's okay. It's like a 1/7 thing. It's not a lot, but this is a long-standing relationship that we've seen for a very long time. The US dollar is negative beta. So what else, Jeff? What else? Risk off. I mean, really, that's about it. So what I would say is this. When you see the stock market and you think, oh, it's only going to go up 6%. What that means, and risk-free rate of return is like 4.5. That means your expected market return to risk, the added gain from risk, is like 3%. That's where I think we are now. Could be wrong, could be 4%, could be 5%, but still small numbers. You're not going to convince me the market's going up 20% this year. I mean, maybe it will, but I don't see it. None of my friends see it. Don't see it. So then what that means is the CQ&S power, or the weighting of return over risk, is only 3. That's low. Very few stocks do better than holding the overall market. There's very few gains to stock picking. But there's some, but they're very low risk. And, of course, there are the exchanges as well. Coca-Cola, McDonald's, Mondelez, Pepsi, Johnson & Johnson, Icon Enterprises, a utility out of New Mexico, Activision Blizzard, Equity Commonwealth. So you got some high dividend stocks in there. It's nice. People are maybe feeling like the dividend's going to help them a bit. And then, of course, you've got the QQQ, the IWM, and the SPY. And you've got your exchange-traded short-term bonds. And then, last but not least, and I'm repeating it, because most people, this is hard stuff to really get your head around. So even I sometimes struggle to get my head around it, right? Not anymore. I've been doing this a long time. 33 stocks. 33 stocks. To get an edge, to get the best edge in the market. That's crazy. I remember when we first started out in 2020, when the market was going up, it would be 2 stocks. And we would put money into the 2 stocks, and one of them would go through the roof. And we were like, yeah! Made money like every week. My God. It's hard to make money on 33 stocks. It is. I don't know. So that's it. Hope you enjoyed the video. If you did, please help me out. We're not paid to make the videos. We didn't talk about any stocks that we own. And I'd like you to hit subscribe. That really helps me. And the other thing you could do is you can go to our website, which is chicagoquantum.com. And I'm not suggesting that you would buy an analysis, but you might want to. I would love it if you did. It would really help me. That's how we make money. And then you can also learn more about our managed accounts, which is terrific. We work with Charles Schwab. We'd be glad to work with you. Or you can buy a consulting project where we would do some research, or we would code for you and run your own firm-specific analyses. We'd love to do that, right? So chicagoquantum.com. Thanks very much for watching. Good luck in the markets. Bye-bye.